Hi everybody, I'm a finance professor and I'm also following AMC and GameStop. And this video is going to attempt to rationalize the values that we see in the market. Now, I don't think that the values are rational with respect to the intrinsic business and the cash flows that they produce. I think that AMC's business is worth far less than the current market cap of the company. But AMC and GameStop have happened upon a new asset, which is this craze among retail investors, where they're willing to pay prices for the stock that don't actually reflect the intrinsic value. Now, as an investor, as a professor teaching market efficiency, we always peg values to the value of usually the business. You look at the filings, you try to estimate the free cash flows. But here again, there's this new asset, which is the craze that's going on, where the retail investors are willing to pay whatever the sky permits. Now, what is this new asset? How do we think about it? Okay, it's really the opposite of a share repurchase. So with a share repurchase, right, a company makes money for the continuing shareholders when the shareholders who leave and sell their shares back to the company do so at a price below the intrinsic value, right? So if I can buy $100 for $80, right, then I make $20 every time I do that for my continuing shareholders, right? That's why you want to repurchase stock at it underpriced, when it's underpriced. But now this is the opposite. So if my stock is overpriced, then I actually benefit my existing shareholders every time I sell that share when it's overpriced. So let's think about a simple example. Imagine we have a company with two shares. Each share is worth $1, so our company is worth $2. Very, very simple example. Now let's say we decide to sell a third share, to a new investor, and let's say this investor is willing to pay $1 billion. Remember the stock is worth $1 a share. That's the intrinsic value. But now, because of the craze out there, right, there's a new investor who's willing to buy a share. We'll sell him a third share, right, and he or she's willing to pay $1 billion. Would you want to do it? Heck yeah, you'd want to do it. The company would be worth $1 billion and $2, right? There's $2 of intrinsic value from the cash flows of the business, and then there's $1 billion of cash that you just raised from the third naive shareholder, right? So the existing shareholders, or the original two shareholders, are much better off. They own 2/3 of the company together, or each of them own 1/3, right, of a company that's now worth $1 billion and $2. Okay, so that's what's going on potentially with AMC. As long as right now, there's actually a bet on how long this craze is going to last, because the longer it lasts, the existing shareholders, right, which could be you today if you bought, right, you could become an existing shareholder, right, you actually might benefit if the craze lasts longer, right, or it increases beyond what the current market expectations are. So the market has some sort of expectation about how long the craze will last, right, and that's actually defining a new asset, which is the ability for the AMC to sell overpriced stock and benefit the existing shareholders, just like in my example, right? So there is possibly a way to rationalize this and actually bet on human behavior. Now the problem is that human behavior is very capricious. This has lasted a lot longer than I would have ever expected, but obviously I may not be the hedge funds and so forth that are in this stock, but I think AMC is actually doing the right thing here by issuing the stock to the new investors at overvalued. When it's overvalued, they're benefiting the shareholders, but they're also benefiting the purchasers in some sense, which is that these purchasers are willing, of the shares, the new purchasers, are willing to pay very high prices. Now, if AMC is coming in and issuing new shares, presumably that's putting some pressure on the prices, so that these new investors are not buying AMC at as ridiculous of a price, right? So instead of having new investors coming in at $60 a share, maybe they're coming in at $50 a share, and their ultimate loss will ultimately be lower because it will drop, down from 50 to something like 10, and instead of 60 down to 10. So AMC is actually doing the right thing by issuing new shares for its existing shareholders, right? selling overvalued stock, but it's also benefiting the new shareholders in the sense that they're paying lower prices than they otherwise would have paid, and they'll suffer lower losses than they otherwise would have suffered. So it's a very interesting setting. I'm happy to chat more about it. My students are asking a lot about it, and this is just my 2 cents. Thank you.